Hello, friends. If you were born before 1966 and you have ever moved more than $10,000 in cash through your bank, for a vehicle sale, a contractor, a family situation, there is a federal rule that can turn that ordinary transaction into a serious problem. And I want you to hold one number in your mind for the next 20 minutes. That number is $250,000. That is the fine the federal government's own pamphlet says you can face. Not for laundering money, not for fraud, but for splitting up a legitimate cash transaction to avoid a bank report most people have never heard of. The lie people are taught is stay under $10,000. The official guidance says that is the mistake. Now, this is not a video about hiding money. It is not a video about tax evasion. This is a video about what happens when a perfectly ordinary person with perfectly legitimate cash does the one thing that makes a bank's compliance system treat them like a problem. Grab a pen. Mark the section that sounds like your life. Selling a vehicle, paying a contractor in cash, helping a family member, taking out a large amount for a major household expense. At least one of these applies to somebody you know. And this whole video is about one word: cash. Physical cash. That is what the federal rule tracks, and that is where the trap lives. This channel tracks bank rules, federal reporting thresholds, and complaint channels, so you do not have to learn them the hard way. These are the details ordinary people hear about too late, after the account is frozen, after the money is held, after nobody at the branch can explain what happened in plain English. Subscribe now and let's get into it. Before we go any further, I want to name two groups because both of you are watching. Group 1. You have savings. You have banked at the same place for 20 years. Your money is clean and you know it. Your assumption is that a long relationship and legitimate funds make all of this irrelevant. You are wrong about at least one section in this video. Group 2. You are on a fixed income. You have heard that moving large amounts of cash is dangerous, and your assumption is that any big cash transaction will automatically make you look like a criminal. You are also wrong about at least one section. I will tell you on every single item exactly which group it helps most. And stay to the end because the last part is the one that gives you the exact sentence to use and the exact place to file if your bank turns a legitimate cash transaction into a nightmare. Let's start. Number 1. The real $10,000 rule is about cash, not your balance. Here is the misconception. People hear if you have more than $10,000 in the bank, the government is watching your account. That is not what the rule says. The real rule is called the Currency Transaction Report, or CTR. In plain English, it is a form your bank is required to file when you make a cash transaction. Physical cash, bills, and coins of more than $10,000. That is the trigger, not your account balance, not a wire transfer, not a check, cash. And there is a second layer most people miss. If you make multiple cash transactions in a single day that add up to more than $10,000, those are aggregated. The bank treats them as one reportable event. Two $7,500 cash deposits do not turn a $15,000 day into two small ones. They still add up to a $15,000 reportable day. Now, here's what the report actually is. It is a bank filing obligation. You, the customer, do not fill out anything. You do not sign anything. The bank files the CTR because the law requires it. And filing that report does not mean you did something wrong. It means you crossed a threshold that Congress set decades ago. This item helps both groups. If you are on a fixed income, you need to know that selling a car for $12,000 in cash puts you squarely in this territory. If you are comfortable, you need to know that a bigger balance and a longer relationship do not make the reporting requirement disappear. Here is what to do. Make a legitimate cash transaction in its natural amount. Do not try to game the number. Walk into the branch and say, "This is a legitimate cash transaction in the full amount." That is it. That is number 1. The report itself is not the trap. The trap is what people do next because they are afraid of the report. Number 2. The accidental structuring trap. Here is the misconception that gets ordinary people into real trouble. If I stay under $10,000, I stay safe. That is backwards. Staying under $10,000 on purpose is the dangerous move. The federal law is 31 U.S.C. section 5324. In plain English, it says that breaking up a cash transaction to avoid triggering that report is called structuring. And structuring is illegal even when the money itself is completely legitimate. Read that part again. The money can be clean. You can owe nothing. You can have done nothing wrong in your life. But if you deliberately split a cash transaction to dodge the reporting threshold, you have created a federal problem where none existed. Here is the part where the fixed income viewer needs to pay close attention. This is the group most likely to act on the folk wisdom. Never deposit more than $10,000 in cash and accidentally create the exact pattern the law prohibits. FinCEN, the federal agency that oversees this, publishes a public pamphlet with real examples. One example. $15,000 in cash, split into two $7,500 deposits on the same day. Another example, $18,000 in cash, split into two $9,000 transactions on different days. Both are structuring. And here is the number. Structuring can carry a fine of up to $250,000 and imprisonment for up to 5 years. If the structuring involves more than $100,000 in a 12-month period, or if it happens while another federal law is being violated, those penalties can double. The statute allows up to 10 years in aggravated cases. The safe workaround can carry a $250,000 number attached to it. Consider a retiree named Walter. He is 68, lives outside Tulsa, retired mechanic. He sold a pickup truck for $15,000 in cash. A family member told him to make two deposits, $7,500 and $7,500, to stay under the radar. That advice would have placed Walter directly inside FinCEN's own published structuring example. The fix is simple. One deposit, the full $15,000, a bill of sale in hand, no attempt to stay under the line. The full amount stays an ordinary, legitimate transaction instead of becoming a self-created structuring pattern. Here is the action step. Bring the paper trail for where the cash came from or what it is for. Do the transaction once, in its natural amount, and use these exact words at the branch. This is a legitimate cash transaction from a vehicle sale. I do not want to structure anything. What documentation do you need so this can be processed in one natural amount? That is number 2. And if you think the legal rule is the whole story, here is the part most people never hear. The bank has its own risk process. Number 3, the hidden mechanism. The bank can review, restrict, or close your account, and it does not have to explain why in plain language. I need you to hear this one carefully, because everything I have covered so far is about the federal rule. This section is about what happens inside the bank after your pattern catches attention. And this is where the comfortable retiree usually tunes out, and you should not. Here is the misconception. If my money is legitimate, the bank will automatically understand. No, the bank does not run on trust. It runs on risk assessment. When a bank identifies activity it considers suspicious, it can file something called a Suspicious Activity Report, a SAR. In plain English, it is a confidential report the bank sends to FinCEN. And here's the part that changes everything you think you know about your banking relationship. The bank cannot tell you whether a SAR was filed. That is federal law. The report is confidential. Your banker cannot say we filed one, cannot say we did not file one, cannot hint either way. A SAR is generally due within 30 calendar days of initial detection, with up to 60 days if no suspect has been identified. That means the bank can be reviewing your activity on a timetable you cannot see, and it cannot tell you that the review is happening. Now, here is what the regulators actually say about what comes next. The OCC, the Office of the Comptroller of the Currency, the regulator for national banks, says there is no regulatory requirement to close an account after ASAR is filed. But the bank may decide whether to maintain, restrict, or end the relationship based on the information available, its own risk assessment, and its internal policies. That decision sits with the institution, not with you. Consider a woman named Evelyn. She is 72, lives outside Tampa, retired school secretary. She needed $18,000 in cash for a roofing contractor and was thinking about making two $9,000 withdrawals on different days because she thought that was the safe way to handle it. That 2-day split is FinCEN's own structuring example. If Evelyn had followed through, she would not just have a legal exposure problem. She would have handed her bank a pattern that its compliance system is built to flag. And she would never know whether the bank escalated it, because the bank is not allowed to tell her. The fix: 1 natural withdrawal, contractor paperwork in hand, a direct statement of purpose to the teller, no tiptoeing around the line. If your funds are ever restricted, here is the action step. Ask for 3 things. Use these words. I am asking for the current status of my funds, the specific documents you need from me today, and the deposit agreement section you are relying on for this restriction. Do not accept a vague answer. Do not leave without something in writing. That is number 3. So far, we have been talking about access. The next section is about ownership. Number 4, the worst case version. Forfeiture risk. Here is the misconception. At worst, the bank just asks some questions and everything gets sorted out. That is not the worst case. The worst case is that the money stops being yours. The IRS Criminal Investigation Division has civil forfeiture authority for violations involving the cash reporting rules and the structuring statute. In plain English, that means in qualifying cases, the government can go after the money itself. Not just charge the person, but seize the funds in the account. And here's the part that makes this different from anything else in this video. There is a federal rule for what the law calls fungible property, 18 U.S.C. section 984. Fungible means interchangeable. Cash in a bank account is fungible. The IRS's own manual gives an example. $10,000 sits in an account. The original funds are spent and later replaced with different funds. Under the fungible property rule, the government can still treat the $10,000 currently in that account as the target, even though the original bills are long gone. The same $10,000 sitting in the same account can still be the money they go after. Now, let me be clear, this is not routine. Most cash transactions do not end in forfeiture. Most CTRs do not end in forfeiture. But forfeiture authority exists in structuring related cases, and it applies to funds in a bank account. This is not a hypothetical risk buried in some legal textbook nobody reads. It is in the IRS's published manual, with examples. This item hits both groups, but it hits the comfortable retiree harder. A bigger balance means a more painful target. But the legal principle does not require wealth. It requires a pattern that triggers the statute. Here is the action step, and notice it is different from every other one in this video. If seizure or forfeiture paperwork appears, an actual notice, an actual legal filing, stop treating this as a customer service problem. Do not try to resolve it at the branch. Do not call the general helpline. Say these words. I need someone who handles federal forfeiture or bank secrecy structuring cases. That is a conversation with a qualified attorney, not a bank manager. Nobody sends you a plain English guide when forfeiture paperwork lands. Nobody walks you through the deadlines in simple terms. You find out when the letter arrives, and the clock is already running. That is number 4. That is the worst case version. Now let me give you the part that is actually usable this week. Number 5. What to do now. The sentence, the documents, and the complaint path. This is the section I told you to stay for. This is where the video stops being about what can go wrong and starts being about what you can do Monday morning. Here is the misconception. Once the bank does this, you just wait and hope. No. There are federal channels that force a paper trail, and they come with real response clocks. If your bank has frozen funds, restricted access, or closed your account in connection with a legitimate cash transaction, and the bank's handling is wrongful or unclear, you have 2 escalation paths that matter. Path 1. The Consumer Financial Protection Bureau. You file at consumerfinance.gov/complaint. The CFPB forwards your complaint to the company, and companies generally respond in 15 days. In some cases, the final response takes up to 60 days. After the company responds, you have 60 days to review that response. Their phone number is 855-411-2372. Path 2. If your bank is a national bank or federal savings association, the Office of the Comptroller of the Currency handles complaints through HelpWithMyBank.gov. Their customer assistance number is 1-800-613-6743, Monday through Friday, 7 a.m. to 7 p.m. Central Time. Once you file a real complaint, the clock is no longer vague. The company generally has 15 days to answer, and in some cases, 60 days for a final response. That is a different world from sitting in a branch lobby hoping someone calls you back. Here is the action step. File a written complaint with the right regulator. Use these exact words in the complaint. I am filing a complaint about a legitimate cash transaction that resulted in an account restriction or freeze. Here are the date, amount, branch, and documents supporting the source and purpose of funds. Bring everything. The receipt, the bill of sale, the contractor invoice, the withdrawal slip, dates, amounts, names. The complaint with documentation is what forces the paper trail. The phone call without documentation is what gets lost. Nobody at the bank volunteers this path. Nobody hands you the complaint form on your way out. The system does not correct itself. You correct it, or it stays broken. That is number 5. So, here is the full picture. The $10,000 rule is about cash, physical currency, not your account balance. One natural transaction in the full amount. No games with the number. The split transaction that feels careful but meets the legal definition of structuring, carrying exposure of up to $250,000 and up to 5 years. One deposit, full amount, paper trail in hand. The hidden bank review layer where the institution decides whether to restrict, maintain, or end the relationship, and where suspicious activity reporting is confidential. Ask for current status, required documents, and the deposit agreement section in writing. The forfeiture rule that makes this bigger than a branch misunderstanding, where funds in an account can become the target. That is a lawyer conversation, not a helpline conversation. And the exact sentence, the complaint path, and the paper trail that give you a real way to act this week. consumerfinance.gov/complaint, HelpWithMyBank.gov, 855-411-2372, 1-800-613-6743. 5 things. one rule that people learn backwards, and 4 layers of consequence that almost nobody explains in plain language. The government does not call and explain the cash reporting rule correctly. The bank does not coach you away from structuring before you create the pattern. The branch does not have to tell you whether suspicious activity reporting happened. The worst case forfeiture paperwork does not arrive with plain English instructions. And the complaint trail does not start unless you start it. Having legitimate money and keeping access to legitimate money are 2 different things. The gap between them is information, and that is exactly why this channel exists. Now think of one person, a parent, a neighbor, a widow handling a car sale, a couple paying a contractor in cash. Not because they are doing anything wrong, because good people are still being taught the wrong rule. And the wrong rule is the one that creates the problem. Send this to one person who still thinks the safe move is staying under $10,000. Subscribe, and I'll see you in the next one.